Hey, it's Joel Scanashi for another variable rate update this week. Just like the rest of you guys, I'm on the road a little bit this week, so just a little bit different setting. Not quite dressed up and suited up this week, but still wanted to let you know what was going on with a few things. So, first of all, we start with knowing that fixed rates have made a meaningful drop down, which is interesting. Even though we see a lot of chatter stopping around rates going up, I think over the past couple weeks, we do have imminently the idea behind um, that prime rate may still go up, which will be interesting because that'll put the fixed rate and variable on on an even keel. But I don't want to dwell on that because I think that's still too early, and we still have a lot more weeks, which beginning in September, until we have our Bank of Canada meeting. Now, this is what I wanted to spend just a moment just putting a refresher around because we get a lot of questions that I think misunderstand what's moving rates and that type of thing. So, first of all, when we think about fixed rates, people go, "Oh, that's really unexpected when fixed rates move up or down." The truth is, it's not really all that unexpected. The bond yields move, and that indicates to us whether fixed rates are going to go up or down the next couple of weeks. It's a leading indicator, and it's 100% predictable. So the way to think about it is if I go to this, if if any type of good, I go and get a TV and the store is buying it wholesale for $1,000 and selling it for $1,500. If all of a sudden they're buying it $900 and now they're selling it for $1,400, now they're buying it for $2,000, so sell it for $2,500. So like we know the wholesale prices, and we know that's going to dictate the yield. So when fixed rates go down or they go up, we know what's happening and we know why that's doing from that perspective. So fixed rates are influenced by that, taking the 1, 2, 3, 4, 5 year bond yield that subsequent fixed rate turn. The variable rate, of course, is, and I know some of this is very basic, and you probably heard it 100 times, but when you take a mortgage, and so if my interest rate is prime -1, so my rate is always 1% lower than the Bank of Canada prime rate. Currently, that rate is 4.7. Now that discount never changes. Prime -1. I have that for 5 years. That's fixed. That amount. So So I'm always 1% below prime. So as prime goes up, my rate goes up, and I either have a mortgage where that affects my payment, or I have a mortgage where it means that there's a different ratio of principal going towards interest. As prime goes up, more is going towards interest, not principal, and the opposite is happening as prime goes down. Now, what really threw me for a loop this year is when we had the Bank of Canada interest rates going up. People go, "Oh, I want to lock in a rate for tomorrow." Irrelevant. Bank of Canada rate is not a rate you can lock in. It's the cost of funds that's exchanged between banks. And so when the Bank of Canada rate changes, there's no rate going up or down that you can control. And so that's really important to be aware of from that perspective. So that's just a little refresher on rates. Where we think things go in the next couple of weeks, I think that if you're getting worried about rates, we have our fixed payment. We have the idea of doing an interest-only mortgage. Not perfect scenarios, but reach out if you want to go through any of those situations because we'd like to help you with that. And those are options. So if we can help with any of those, please do reach out. Please share this video with as many of your friends and family as you can. We love to have some more subscribers to the channel. We have some other videos we're putting out there that I think could be helpful as well. And we'll talk to you soon.